In this week's update, go where the profits are. Finally, some decent US market breadth and plenty of contrarian opportunities waiting. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. Let's start with the market perspective because it was an excellent finish to the week, and I would imagine that the Australian market will probably open in pretty positive sentiment on Monday morning. Let's take a bigger picture look at what's going on, which is always important to set the foundations for what you're doing. 2022 was a pretty poor year, except for energy and for a period of time for lithium. Everything else, pretty much dragged the chain. History shows over a long period of time that the following year, after a down year, is generally far better and it's generally positive. Not every single time, but generally that is the case. So we can certainly look forward to 2023 being a positive year, and so far that is the case. That's the way that it's pointing, particularly in the US. So are the US market index rises, are they justified? There's just so many problems and issues out there, so many headwinds for the market that everybody knows about, that it's very easy and very logical to come to the conclusion that the market can't possibly go up, but the fact that it is. But let's actually have a look at some of the facts rather than the emotional media reporting. Quarterly earnings and the outlooks have generally beaten expectations. Now, there is an argument that says that expectations were unrealistically low, and so of course you're going to beat them. But nevertheless, the earnings came in better than expected at a pretty good level. But it really was the outlook statements that was certainly more positive than what the market was expecting that is helping. The gains were very narrowly based, and I've been commenting on that for many, many weeks. But Friday saw a dramatic shift. And okay, it's only one session, but is that now changing? Because it was such a dramatic shift, as you'll see. To me, the way to deal with an uncertain market, a market that is being driven by small sections only, this is not a broad-based rally by any stretch of the imagination, then you want to own companies that have got basically unbreakable tailwinds. Doesn't matter what central banks do with interest rates. It doesn't matter what happens with China. It doesn't matter what happens with Russia or inflation. They're companies that have got tailwinds that are going to be able to keep growing their earnings. And also, they've got to be able to raise prices in an inflationary environment. And so the companies that have got those earnings tailwinds and have the ability to raise prices and not lose business, that's what you're after. There aren't a lot of them out there in percentage terms, but they certainly are out there. Now, it's a very simple concept, but it's not easy to do because we've got a lot of market noise around us and we've got a lot of internal noise in our own heads telling us that, logic would have us do something different. So it's not easy, but it is simple. And those companies do exist. And with a lot of hard work, you can find them. The bottom line is this, in my view: we must go where the potential and also highly likely. So lots of companies have got enormous potential. You look in the mining space, there's hundreds of companies that have got fabulous potential that you can get excited about. There are so many new technologies that have got incredible potential that you can get excited about. But in Portfolio Analyst, I've been analysing those companies that members have asked questions about since 2017. And I would say that at least 80% of them have gone backwards and have gone considerably backwards, despite the fact that they've just got an incredible story that looks like an absolute no-brainer, and yet you look at the share price 2 years later and it's down 90%. So there's lots of companies with lots of potential, but it's got to be also highly likely to be realised. And when you've got that combination and it dwarfs the downside risk, so the company is not expensive at this point in time, then you're on a winner, and that's what you're after, and that's what I'm constantly looking for and accumulating. The risks are always going to be there. There's always going to be, recessions, inflation, China, wars, whatever, commodity price manipulation. The risks are always going to be there. But despite what a lot of people might think, and it's easy to slip into a victim mentality, we can control most things in the market. We can control what we buy, how we buy it, how much we buy of it, how we take profit, etc., etc. There are not that many things that we can't control, so just focus on those ones. And you've heard me say that many times. Now, right now, there's quite a few contrarian opportunities. They're very much in the mining and battery materials space because of some short to medium term headwinds, but certainly they're there. Copper and graphite offer enormous contrarian opportunities at this point in time. Rare earths, definitely. The timing makes it harder because China is out there manipulating the price to try and ward off the competition so that they can retain control of the supply chain. That one is a little less clear to me in terms of when we might see a rebound in rare earths prices, but it's going to happen. Oil and gas is also, I think, got a long-term tremendous outlook because of just years and decades of underinvestment. But again, timing that one is a bit of an issue. And mining services, with all the mining that's going on and has to continue to go on for the rest of this decade, mining services companies are doing well. They're doing well now, but the market's not interested. Terrific contrarian opportunity in that area. All right, let's look at the American stocks. The S&P was up 1.8% for the week in a very powerful finish to the week, as you'll see. It's essentially an AI-inspired rally since NVIDIA came out with their results a couple of weeks ago. AI has just gone absolutely ballistic, and any company that is in that space has been pushed up. So that's certainly led the rally, but it's starting to drag the sentiment for the rest of the market up as well. But one of the things I've been talking about for weeks now is the lack of breadth, the fact that 10 stocks were basically driving the market and all the rest were going down. Well, Friday night in Australia, so the Friday US session saw a huge surge in small caps, and it wasn't just profitable companies. I mean, Cathy Wood's ARC funds were all up into the end of the week as well. So the money is really percolating throughout all areas of the small cap space, and that is different. One of the things you want to look for when trying to identify turning points in the market is when something occurs that you wouldn't expect to happen. It's a positive price surge going against the negative news. And that often marks significant turning points in the market. And Friday night could have been it. US dollar slipped a little bit, 104.04. The 10-year yield was higher during the week, but ended up down at 3.7 to finish. The VIX is down to 14.6, which is the lowest level in 3 years. So the market really is starting to get pretty comfortable with things. But the 10-year, 2-year spread widened again. It's now negative 0.81, which makes it virtually a no-brainer that the US is going to enter a recession. We've never been this negative for this long and not had a recession in the US, so that's almost a given. So let's go and look at some charts. So this is the S&P. You can see Thursday and Friday were very good sessions, especially Friday. Very strong, closed almost on its highs. So that is the S&P. Now that is dominated by 6 to 10 mammoth stocks. The Googles and the Amazons and the Apples and Meta and those sort of stocks. And you can see that all the moving averages, short term and longer term, are now all pointing up, and the price, the index is significantly above all of them. So all the orientation is to the upside. But let's look at another ETF, which is, so this chart is market cap weighted. So the biggest stocks are having the biggest effect on that index. But there are also equal weight ETFs in America, which basically weights all 500 companies by the same amount. So a small the 499th company in the S&P has the same impact as the number one company in the S&P. So you can see the equal weight has been underperforming significantly, which is what you'd expect to see. So all the moving averages are basically just grinding sideways, and the price was, up until Friday, was actually below them. So we had, we had most of the companies were actually heading down. But look at Friday, a huge turnaround on big volume, and we broke this downtrend line. Now, none of these things in isolation are aha moments. You can't look at one chart and say, okay, that's it. That's the signal I've been looking for. But it's weight of evidence. And that is a key point in the weight of evidence to my way of thinking. Let's look at small caps. So let's look at IWM. So there's IWM doing nothing, moving averages just sideways, pretty somber price action until Friday. Bingo. Huge move, big gap up, large candle, closed on its highs, big volume. We've got to go back to the sort of volumes that we saw when the index was actually sliding. So now let's look at some of the other key charts, the key spread charts. Where's the money going? Well, the Nasdaq versus the S&P turned down a little bit on Friday, but overall you can see that that's an incredibly powerful outperformance by the Nasdaq, and we've been seeing that ratio unfold now for months. Semiconductors versus the S&P, the same. Enormously powerful move in semiconductors. Maybe a bit overdone with stocks like Nvidia and the like, but nevertheless, that's the outperformance. Now let's look at the relative comparison on a sector basis. And I would note, for those of you that sort of get caught up in these, these sayings, sell in May, go away. It was all over the media in the end of April and the start of May. But May so far has been pretty good in the US. So this is over the last quarter. So technology at the top, then communication services, then discretionary. So they're the aggressive sectors. They're all pointing up, and they are the leaders. All sectors have turned up in the last few weeks. So that's one observation from the chart. But it's the fact that it's the aggressive sectors of the market that have been getting the money flows. Let's zero in just a little and have a look at the last month to see if there's anything different there. No change in the order, except that the moves really have been very, very powerful in the last month. So that's where the money flows are going. So it's all positive except for the breadth, and Friday night may have just been the turning point for that breadth. So pretty exciting times if that follows through. Right, I'll just have a quick look at the iron ore chart while I'm here before I go to the Australian data. So this is iron ore, which is obviously critically important for XMJ, the materials sector in Australia, and it would appear that iron ore has stabilised. We've been in this area now just a tick under 100 to 110 since basically the end of April. So about six weeks or so. So hopefully some stabilisation in the iron ore price. Turning now to Aussie stocks, our dollar 65.42 was lower than that. Our index was down 0.1% across the week, but you would expect that will probably kick up. But look, the ASX 200, and this is relevant if you've got your money managed in a fund which is a broadly diversified fund, then the ASX 200 is at the same level as it was before the COVID crash in 2020. So that's 3.25 years where a broadly based portfolio of stocks has done nothing. And I can tell you that there's been some incredible returns during that time, but that's the reality. Now, the XEC, which is the Emerging Companies Index, which are there are 200 companies ranked between 350th and 600th on the Australian market by market cap. So they're not what you'd really call small caps or micro caps, but they're still well down the pecking order. But that was up nearly 2% for the week, and that sort of mirrors what I was just talking about with America. Is our iron ore stabilising? Look, it's only 6 weeks or so. It's a bit hard, a bit early to say at this stage, but certainly at this stage, China, the way their economy is going, would appear as though they've got to introduce some sort of significant level of stimulus to get things going again. Their inflation is not a problem. They can do it from that perspective. So let's hope we see a resurgence in iron ore demand from China. So let's go and look at a few of those charts. I'll just look at the crude oil chart. I'll come back to this. So this is crude oil over the last, this is the day, so just 71.9. But let's look over the last month to see what crude oil has done. Sorry, that's not changing for some reason. There we go. All right, there's crude oil over the last month. We had a low point of 68. We had a peak of 74. So that's been the range, and we're in the upper portion of where crude oil has been over the last month. Just before I go to Australia, we'll just check the currencies. There's the US dollar on a weekly chart. So it's at the top of this range that it's been in now since, you've got to go back to December. So pretty much this is the range for 2023, and we're almost to the top of that range and stalling. But the Australian dollar is, if anything, the Australian dollar is trending down. Okay, let's look at the ASX 200. So this is the level that I spoke about. So where we are right now, you can go back all the way back to the 7th of May, 2021. And then before that, the peak just before the COVID crash on the 19th of February. So there's been a huge amount of up and down in the middle, but a broadly based portfolio has effectively done very, very little in that time. Precious metals, gold was up just $1 to 1948. So gold is under pressure in this environment. But look, there's a lot of things that could flip that around fairly quickly. I think as soon as the Fed makes noises that they're going to pause or in fact cut rates, and if inflation hasn't come down, which is more than likely, then that's a pretty good environment for gold. Falling interest rates, but still high inflation. Now on Friday night, the jobs report came in well above what was expected, about 320,000 jobs. That was much higher than the market wanted. So the interpretation was more rate rises needed, which meant a higher US dollar, which equals, and I've been covering that now for a long time. So not a particularly positive fundamental situation for gold. In Australian dollars, with our dollar pushing up a bit and the gold price down, we're now down under 3,000 in Australian dollars. Precious metal stocks, pretty boring at the moment, reflecting the weakness in the metals market. So we'll take a look at gold. There's gold on a weekly. Not a lot of change, only the $1 change for the week. And look, we're still getting higher highs and higher lows. I mean, let's be realistic here. It's disappointing to see gold back down in the 1950s, but the trend on a weekly basis is still looking pretty good. And in half a dozen weeks' time, this could be looking significantly better. The daily chart, quite a good gains throughout the week, but then all of that was pretty much lost on Friday night. And silver is pretty much the same. It's not really going anywhere at the moment. Turning to other commodities, copper was higher a little bit, 3.76. We got down to about 3.5. Nickel at 967 also kicked up a little bit. Copper stocks have been hit hard the last few months. The falling copper price, fears about recession, etc., all those headwinds. But look, the long-term outlook for copper, particularly if you go out to, say, late 2024, 2025, is incredibly powerful. And to me, that's just screaming a contrarian opportunity. Stocks out of favour, some short-term issues, but long-term looks amazing and looks virtually almost certain the way that things are developing in the battery materials space. So, copper has got to be a real contrarian opportunity. Crude oil, 71.87, as I showed. And one of the interesting things in that market is that stocks are just starting to show some resilience to the bad news in the oil space. So I think we're quite probably at a turning point in the crude stock prices as well. Let's just check in on lithium. It was another week of positives. The benchmark minerals lithium index on product prices, which is really a basket of prices, was up 17.4% for the week. So that's a really nice gain. However, you could argue that the prices were down so far that this is just a bit of a relief rally. We'll have to wait and see. But certainly the fundamentals look amazing. And corporate action remains buoyant. So the major players, who, let's face it, will really know what's going on rather than some investment bank analyst or the media, they're putting billions and billions of dollars into corporate action. So they're not going to be doing that unless they've got absolute confidence in the dynamics of that market. So it's still all very positive for lithium. And we're now starting to see in the market that great projects, the projects with the X factor, are increasingly being embraced. And we've seen some absolutely rocketing share prices in a few stocks. Now, it might be, 2 or 3 in 200. So this is not an environment yet where you can just go and buy any old lithium stock that you got a tip on, or some media analyst has written a story about a particular stock. You still need to be incredibly discerning about the stocks that have got the X factor, and that X factor could be the resource, it could be the track record of management, it could be any one of a number of factors, but they've got to have something that elevates them in the mind of the market above their peers. Here's the copper chart. You can see quite a nice rebound happening, but we've still got a long way to go. But the expectation is that copper is going to be $4.50 to $5 within the next handful of years, and that because of the leverage effect, that makes it outrageously profitable for a lot of the emerging developers. There's a spot nickel chart, also a bit of a tick up. So wrapping it up, the ideal mindset to have in this sort of market that still has a lot of uncertainties, things that could go wrong, is to avoid the crowded trade. A lot of people are jumping into what is already a crowded trade, and that's normal because there's been a lot of nervousness around now for well over a year. When the markets are nervous, they look for more confirmation before they jump into certain stocks. It's just human nature. And generally, you don't get that confidence until something has been running higher for quite some time. And so it's very easy to get drawn into the crowded trade. You want to avoid that. My belief is, and my practice has been, to seek contrarian opportunities where they're well and truly justified, where the outlook is virtually a given, and just go from there. We don't want to guess. We want to demand earnings certainty either now or, in the case of emerging companies that have got that X factor, then you want that earnings certainty into the future. You want to see a pathway to producing positive earnings. Now, sometimes that means it could be in stocks that don't really represent value, and CSL is a great example. You know, it's one of Australia's best companies. It's one of the world's best companies, but it's never been cheap because it just is so good. And there are other companies out there like that. So you're never going to get them on the cheap. But they still are capable of producing a terrific return over the long term. And they're stocks that you can own for 10 or 20 years. So sometimes, don't get too caught up. If the stock ticks all the boxes, then sometimes you've just got to pay up for quality. Portfolio analyst last week, we did look at a very compelling long-term opportunity that is along the lines of what I just spoke about. And we also looked at quite a few development stocks, and the key message was that you got to follow the chart more than the story. Out of hundreds of stocks in say the mining space, only a very small handful are going to make it and are going to make it big, and all the rest are not. So the chart is the important thing. That's it for this week. More information on the website. This is my email address. I'll be back with you next Sunday. Cheers.